Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about housing affordability and what it means for you as either a millennial buyer or an existing homeowner. We'll unpack that and more. Stay tuned. Housing affordability. It has been a very hot topic for a long time here in Canada. And this week, with the government introducing new spending for measures to help Canadians with other expenses in light of all the inflationary pressures, the higher cost of living, it is important to have this conversation about housing affordability when it comes to those Canadians who are looking to get into the market or those existing homeowners that have a mortgage and maybe are looking to make a move. And obviously over the last 7 months, there has been many challenges facing homeowners and affordability. And with the data coming out from the National Bank of Canada's Housing Monitor, as well as some of the data coming out from Royal LePage when it comes to homeowners and millennial buyers and their sentiments, when it comes to affordability, it is a very important topic. So I want to try to unpack this a little bit now and have a conversation about housing affordability. And starting off with, how is housing affordability gotten this bad? How? Over the last little while, lower interest rates have spurred on demand for housing. Elevated home prices over the past few years have severely deteriorated the dream of affordability for many Canadians looking to get into the market. Higher inflation numbers have made the cost of living more expensive. As the cost for labor and material increase, homes become more expensive not only to maintain, but to build. Moreover, housing affordability in Canada has now reached its worst level in 41 years in the second quarter. Even now, with home prices down from the record high in early 2022, increases in mortgage rates have not made affordability better in the latter half of 2022. According to the National Bank of Canada's latest housing affordability monitor, we have seen 6 consecutive quarters of declines in housing affordability. But with home prices down significantly in certain markets, and as we begin to see some stabilizing with fixed rate mortgages, National Bank of Canada found that affordability should begin to improve according to the report. Now, obviously, that is a little bit contradictory in regards to what we've seen happen just this week here in Canada and mostly in the US, because of the fact that the bond market has surged on the data out of the US on regards to their inflationary numbers now coming in higher than expected. And obviously that means that Canada as well is projected to be a little bit more elevated as we wait for the data to come out next week. Now, obviously, including all the inflationary fears and pressures and higher interest rates, it is important to talk a little bit about the stress test, because that is important. Tighter stress test rules due to higher interest rates have not only increased the cost of borrowing, but have impacted qualification for buyers and existing homeowners. To add to that, basically out of OSFI, the Office of the Superintendent of Financial Institutions, and Peter Rutledge, there is no line or no sight of change to the stress test rules coming anytime soon. Now, with all that, looking at affordability, where we've been, where we're going, the question is what makes up affordable housing? What is considered affordable, and what should we as Canadians be budgeting for? Well, according to CMHC in Canada, housing is considered affordable if it costs less than 30% of the household's gross income. Now, that's pre-tax money. It is widely agreed on paper that housing expenses shouldn't be more than 30% of what you earn, leaving 70% of your income for savings, food, clothing, transportation, and other necessities. If you spend more than 30% of your income on housing expenses, you can be considered over-leveraged. To add to that, mortgage payments as a percentage of household incomes have usually averaged around 40.7% since the early 2000s. To put that into context, in 2019, the average Canadian spent around 45.9% of their income to meet housing costs, which includes taxes, rent, mortgage, and other payments and utilities. These recent increases to interest rates have now propelled the benchmark mortgage rate to its highest level since 2007, the report noted. A 123 basis point increase represents a surge in 14.4% in mortgage payments on the national composite, or basically an extra $500 a month, assuming there's no change in home prices. Now, that means that with the average of 63.9% of household income from a representative household is required to service a mortgage in Canada's main urban centres. The report also found that that's up over 10 percentage points from the first quarter of this year and up a whopping 19.1% from just a year ago. And now, with the policy rates expected to come up again in October and in December by the Bank of Canada, these household numbers will definitely get worse. And if you think that was bad, imagine cities like Toronto and Vancouver. Those increases to the cost of living and servicing those mortgages are as high as 91 or 96%, respectively, of those medium household incomes, not leaving much left over for those Canadians to spend on other curricular activities. Conventional banks right now are currently using a servicing ratio or debt servicing ratio of 39% GDS and 44% TDS. Now, all those numbers are always calculated on before tax income to qualify. So looking at that data, it's very important to understand that 39% of your income, pre-tax income, cannot go towards servicing the mortgage, principal, interest, and heating. And no more than 44% of your income can go towards servicing other things like your lines of credits, credit cards, car payments, so on and so forth. And those are the requirements set forward by the most conventional banks. Now, there are banks that will look at extended ratios, and it is always dependent on the type of deal. However, with these numbers, is there any affordable housing in the GTA for Canadians? Over the past 2 years, changes in the labor market and immigration have definitely impacted the real estate market. There's no doubt that many Canadians, especially young professionals, have changed their priorities in life and future goals due to the impact of the pandemic on the workforce and how and where they work. As people's tolerances for commuting declines and their desire for greater flexibility regarding the hours and location of their employment shifts, strong real estate demand is no longer concentrated just in major centers, but it has expanded to many other suburbs where home buyers can purchase a larger, more affordable property. Millennials who entered the market before the economic boom are also now able to step up in home size, taking advantage of the equity that has grown in their homes. According to the data, new purchasers will need to enter the market however and wherever they can. To add, a lot of conversations that we're having with a lot of millennial buyers and those looking to engage in the market, the thought is that even with higher interest rates, even if their monthly payment on a more expensive property are the same today as to what that would have been in February and March, their down payment would be substantially lower, and so would the income required to qualify. But every person has its limits. For many, the thought is that buying a home at a lower sticker price is in the long run more advantageous than lower interest rates, since mortgages have rates and terms that can be renewed every 3 to 5 years. The question is, how high will mortgage rates go and how low will home prices continue to fall? Speaking with a lot of first-time home buyers, even existing homeowners, the question is, where did all the people go? According to Phil Soper, President and Chief Executive Officer of Royal LePage, many Canadians who are in the stage of life where home buying is top priority, especially for millennials under 35, who remain committed to achieving home ownership and are optimistic about the opportunities that lie ahead in the coming months and years. The belief is in large part due to the example of their parents and family members who have reaped the financial benefits of our historically strong real estate market. According to the data from Royal LePage, between now and 2027, an estimated 4 million Canadians will be looking to buy a home. Let that sink in for a moment. The poll recently found that 60% of Canadian millennials, those between the age of 26 and 41, who do not currently own a property, expect they will own one in the future. However, of those numbers, 52% claim that they would have to move away in order to fulfill that goal of home ownership. Worse, with 25% of millennials nationwide who are not homeowners think that they will never buy a house in Canada because it's unaffordable. All in all, when will these buyers come back to the market? Buyers of all shapes, sizes, and ages, especially those trying to enter the market for the first time, face difficulties due to Canada's persistent housing supply and its shortage. Millennials are resilient and willing to make the required sacrifices to accomplish this milestone and are currently the largest percentage of our population and possibly the most impactful on the future of the housing market. Royal LePage anticipates market activity will pick up again, although slower than we saw in 2021 and in early 2022, I may add. Yet, Royal LePage sees the current slowdown in the real estate market activity as a result of potential buyers temporarily putting their home purchasing plans on hold and seek to understand the full impact of rising interest rates and inflation on their bottom line. They also shouldn't forget to add in that there are many buyers out there looking to try and time the market bottom. Housing stock will be needed to maintain a balanced market and help Canadians afford housing and basically help Canadians come back to the market. The problem will get even worse once many return to purchasing homes as the population grows, primarily due to increased immigration levels and changes to household formations. Family formations have definitely changed over the last little while with increased prices in homes and obviously the cost of borrowing. Individual households comprised of boomer parents and their millennial children are evolving into 2, 3, and 4 family buying larger homes to live in. All things considered, although multiple offer situations and strong competition for homes may have decreased recently, young buyers still face difficult obstacles because the cost of borrowing and the lack of less expensive inventory are just not available. We are now seeing thousands of condo projects canceled and developments putting their projects on hold across the country. This will basically make the problem of housing supply much more relevant and much more challenging in the next 3 to 5 years. With that said, policymakers are aware that additional supply is needed to meet the demand of future millennial buyers, projected immigration targets, and obviously the pent-up demand for who were unable to buy a home over the past few months, and let alone the past few years. Following the short-term economic downturn that we saw in 2022 and currently, Royal LePage noted that the possibility of another spike in price appreciation when marginalized homebuyers come back to the market. That is in large part due to all the ages of Canadians who still have a strong desire to own a home at some point. The majority still value home ownership and see it as a long-term investment in their future. Despite the unpleasant reality that many young people are facing, that buying their first home today is more challenging than it was for their parents in the past. Given that millennials today will definitely be facing several obstacles, much like their parents may have faced back in the day, and the article does point out that it was simpler for parents to purchase a home back when things were a lot more different when it came to mortgage regulations and qualifications. I do believe that many millennials like myself who see the value in home ownership will execute on those dreams if those dreams stay alive. And it is now up to basically our government and our Bank of Canada to get us out of this situation and put inflation back down to its target range of 2 to 3%. And although there might be some significant pain in the next few months as we see the Bank of Canada get ahead of inflation or try to get ahead of inflation, we hope to see things come back down. One thing is for certain, I can tell you this, I do not think that we will see interest rates as low as we did just a few years ago, but they might be coming back down as soon as the markets start to see some relief on those inflationary numbers. But obviously the data will tell us more about what is to come, and as we await the CPI inflationary numbers for Canada next week, we'll definitely be doing more videos to have this conversation about affordability in Canada and what it means for Canadians to get into the real estate market. If you like the content that we're producing here at In Touch Mortgage Solutions, don't forget to smash that like button, hit the like, share, and subscribe button, and that notification bell. Leave your comments in the comment section below as it helps the algorithm on YouTube. And we'll end the video here. We wish everyone a great Friday and an even better weekend ahead. Until next week, thanks for watching.